out there. Trideep Bhattacharya is with us, CIO, Equities, Edelweiss AMC. Trideep, great to have you with us here. Appreciate your time. Do you believe, Trideep, with the three things which have happened so far, the tax cuts, the interest rate cut, and of course the GST cut now, ingredients are in place for a bit of a revival? Markets, of course, they can be lead lag, but do you think it's a much better setup, supportive setup for consumption to take off? What's your sense?
Absolutely. I mean, if you put the math behind it, then the total impact of tariffs arithmetically is roughly about 0.5 to 0.6% of GDP. And if you look at the consumption stimulus that we got yesterday in the form of GST cut, tantamounts to broadly the similar sort of a number. So dollar for dollar, I think it has been matched to the extent that the demand deficit or the impact that could come through on the back of tariffs is actually negated by the consumption stimulus. The thing to keep in mind is these two, of course, affect different stages or different parts of the economy, and those impacts will be there. But if you combine this consumption stimulus along with rate cuts and a possible rate cut going forward, lowering inflation, I think the ducks are lining up for a consumption recovery post-festive season in a meaningful way. I mean, last time when we saw such a cut in that was in GST cut in back in 2017, we saw a meaningful price elasticity of demand, meaningful pickup in volumes, particularly in areas like autos and FMCG. I think it'll probably kind of happen to a similar extent over the next 2 or 3 months, and that's hopefully ends the earnings downgrade cycle that India has been for the last 12 months, and that should mean better days for markets over time.
I just want to make and point taken, Trideep. Pull up MOSCHIP, MOSCHIP. A MOSCHIP is and the reason I'm mentioning it never comes up, but it's the biggest volume-led gainer on the NSE. It's up 7%. There you go. And this week it's up 40%. Exceptional volumes. I think this is the highest weekly volumes ever on this company. It's a Hyderabad-based company. It's got chip at the end of it. And by the way, it is in semiconductor design and sort of system design and in that area, and maybe Hormuz can dig in a little deeper in terms of why this one is getting so excited. There is, of course, the backdrop that Semicon Week, which happened, a 3-day event in Delhi, but I'm not sure if this has got something to do with it. Prime Focus, I think we mentioned, it's limit up now. It's up 10%, Prime Focus, so 158 rupees on that one. And MobiKwik is another one which is starting to come up a little bit, 1.5% higher. SKF India is up about 5.25%. So just want to highlight that as well. And Quality Power is up 5%, 906, 907 as we begin the session right now. Niva Bupa is up 3%. And so, more and more stuff coming into the front as we go through the motions. Just still about first 5, 6, 7 minutes of market open. Surabhi.
Okay, that's how it's playing out. Trideep, hi, great to have you on. So obviously consumer stocks have been benefiting from this run. But, I was taking a look at the fine print, and actually even for industrial goods, for a lot of defense equipment, there are substantial rate changes and things like, small things, walkie-talkies, or even big things, components that go into drone manufacturing, etc. There are cuts across the value chain for industrials and for defense. So just tell us, in terms of across the board, how's positioning now on sectors? Where are you on industrials? Where are you on consumer? And if you will be tweaking or changing anything in a more meaningful way, in a more structural way, because of the GST reform?
Sure. So I think overall, I'll start with consumption to answer in the true honest. So if you sort of divide consumption into 3 segments, one is luxury, second is mass, and third being rural. We have been overweight in luxury consumption as well as rural consumption for a good while now, in the last 3-6 months. The part of consumption that we were underweight were mass consumption. I think that's where we have added leading on to this GST announcements. And I think we're going to stay put in that direction. And if there are any weaknesses that might come through, we'll kind of add to that. So if you put that in context, then various aspects of consumption, large ticket and small ticket, we are clearly overweight. With regards to other sectors, the other areas that we are betting on were specifically on government capex. Now, while earlier in Modi 2.0, if I may call it that way, it was fairly widespread with regards to government capex and hence industrials. This time around in Modi 3.0, it will be a lot more specific. Areas like defense, railways, and power are the three such segments where I think the spending with regards to government is likely to be focused, and that's where our portfolios are oriented towards at this point in time. The third area that we like are the rate cut beneficiaries, which could be kind of NBFCs in the context of financials at reasonable valuations have come off of late. We need to calibrate a couple of impacted industries like textiles, etc., and the impact on the same, and also the floods that have come about recently. But net still, they offer decent valuations along with growth prospects going forward. So that's the third area that we have that we are overweight. And what's funding these overweights are broadly commodity-related sectors, whether it's oil and gas or metals and mining. Tactically, they could be in and out, but broadly speaking, we remain underweight in those spaces. So that's been the positioning as we speak. Of late, we have added to mass consumption, and in the weakness to a certain extent in financials is what I would say we've added on to.
Okay, all right. Hi, Trideep. Good to see you, Ben. What about autos? Maybe in the near term, we'll have some kind of uncertainty and some pause of buying. But otherwise, we could be bracing for very good times with the vehicles getting a little cheaper. What's your approach to the auto segment? Autos, auto ancillaries?
We've been overweight. That's part of consumption. When I say consumption, maybe I should have specified it a bit clearly. But we've been overweight auto OEMs, to be precise, particularly in two-wheelers. And of late, given that the four-wheelers are coming off a lower base after having underperformed for a good while, we've added to four-wheelers as well. But autos is an important part of consumption and would be overweight in our portfolios as we speak. And we've increased weightage over the last 3 to 4 months as well. Global focused auto ancillaries is something that we have taken a dim view of. We are underweight in that segment. We probably continue to remain that way. But domestic focused ancillaries and OEMs is something that we are focused on at the moment in the context of autos.
Okay, got that point. Trideep, the wider question, do you think from an earnings perspective, anyway, US tariffs were not going to have a very direct impact on earnings because it was more focused on specific areas like textiles, etc. But for what it's worth, I mean, to what extent does the GST cut offset the impact, first order or second order impact, that the tariffs would have had on growth and earnings?
So two aspects to that. One, dollar for dollar, it does. So if you look at the total impact of the tariffs so far, including the 25% tariff that have come through, is roughly about 0.5 to 0.6% of the GDP directly. And if you add up the consumer stimulus itself that came about in the form of GST cuts, that itself tantamount, they are equal in amount, without adding on to the tax benefits that were given early in the year, and also the loosening of the purse driven by lower interest rates. So net, we have value for value, we have sort of masked the impact, whatever it was meant to be in the context of tariffs. However, the areas that will kind of get impacted, which include textiles, gems and jewelry, and seafood, are specific industry-specific impact, whereas this is more broad-based. So the areas of impact could be a little different, and that's what we as an economy will have to contend with. But dollar per dollar, so far, in terms of direct impact, it's been masked through. And I think in that context, one must compliment the government that they have done whatever they could do in the form of giving the boost to consumption, and that hopefully in a second order impact, maybe sometime next year, could kickstart the private capex cycle, which has been missing for a good while.
So I mean, to translate that into earnings growth, and usually this is a question that we ask the sell side fellows, the stockbrokers, but let me ask you, I mean, the street was hopeful for 12, 13% kind of growth. Then Q1 was patchy. So then we said, okay, maybe cut it down by 1%. But as things stand, how much earnings growth are you expecting this year? For at least the stocks that you own, or for, it could be any wide index, BSE 500, anything that you choose to benchmark by?
Sure. So the background has been that in FY25, we started forecasting about 13% growth, or we ended up being a low single digits. So we are sitting on a good amount of earnings cut so far. So with that lower base, I would expect the Q2 also to be lackluster because that will kind of go a bit like lost in transition. Q3 onwards, we will see a pickup in growth rates meaningfully come through with regards to India earnings forecast. And given that in mind, somewhere between 10 to 13% is what I think my expectation could be. I think the last round of cut might happen along with Q2 earnings. But if the outlook for from the corporates that we hear in the Q2 earnings season, which is the upcoming season, turns out to be positive, the stock prices might have a different story to say. Given that the last 8 days for the month and then onwards, we could see a pickup in demand driven by GST cuts and whatnot. So fairly critical earnings season coming up, I would say. But remain hopeful that this will be that makeover quarter, or the transition quarter from earnings downgrades to upgrades overall for the back half of the year.
All right, Trideep, we'll leave it there. Good conversation as always. Thank you very much for coming on. Appreciate it. Have a good weekend and speak to you soon again.